Welcome back to Investing Talk Podcast.
Today we're looking at Lumentum.
As usual, before we start, subscribe, like, and comment to this video to support the show.
It really helps us keep bringing you these deep dives into the market.
Yeah, absolutely. And today's topic it's a big one. Because when you and I talk about the AI boom, or really when anyone talks about it, the conversation almost always goes straight to large language models, right? Or those, $30,000 graphics processors.
Right, the GPUs. That's what grabs the headlines.
Exactly. But there is this entirely secondary battleground in the AI revolution, and it doesn't get nearly the mainstream press it deserves, even though it's literally based on the physics of light.
Which is such a crucial distinction for you to understand if you're trying to figure out the current market dynamics.
Mm-hmm.
We are officially entering what I would call an AI optics supercycle.
An optics supercycle.
Yeah. Because to grasp the sheer scale of this, you have to look past the processors themselves and focus on how those processors actually talk to each other.
The networking side of things.
Exactly. Picture a modern data center for a second. You've got tens of thousands of these advanced GPUs stacked in racks, right? To train an AI model, those chips need to share massive data sets instantaneously. And for decades, the tech industry relied on traditional copper wiring to move that data around.
But copper has physical limits, right? I mean, we're hitting a wall there.
A massive wall. Trying to run modern AI workloads through copper wiring is, it's like trying to drain a swimming pool through a garden hose.
That's a great visual.
The bandwidth just simply isn't there. The signal degrades over really short distances, and worst of all, copper generates heat.
And these data centers are already running incredibly hot.
Right, you're running thousands of GPUs that need heavy liquid cooling as it is. Adding heat from the network cables is just a nightmare for these hyperscalers. So the only viable physical solution is LITE.
Which means upgrading to high-speed optical networking.
Precisely. You have to upgrade. And that brings us to the core of today's analysis. We are examining Lumentum because this is the company that serves as the critical physical infrastructure powering this exact transition.
Which sets up this really fascinating tension for us to explore for you today. Because on one hand, you have a company showing just unprecedented fundamental growth, and they're backed by this staggering multi-billion-dollar partnership with NVIDIA.
The NVIDIA partnership is massive.
It is. But on the other hand, if you look at the stock chart, it is exhibiting just stomach-churning volatility. I mean, we are talking about dizzying highs followed immediately by these steep, sudden drop-offs.
It's been a wild ride, for sure.
Right. So the central question for you as an investor listening to this is, does the underlying business reality of Lumentum actually justify the crazy ride we're seeing in its share price?
That's the ultimate question. And to find the answer, we really have to strip away the daily market noise, put aside the Twitter hype, and look at the actual foundation of the business they're building.
Okay, let's pivot to the fundamentals then. If they are building the physical fire hoses for the AI revolution, let's look at the actual business foundation. We need to see if the recent numbers justify all this hype.
Let's do it.
Because their second quarter of fiscal year 2026 was, well, it was eye-catching, to say the least. But as an analyst, I need to know if it's sustainable. They reported $665.5 million in total revenue for the quarter.
Which is huge.
It's a 65% jump year over year.
It's a remarkable leap. And it really helps to break down where that money is actually coming from so you can understand their business model.
Right, break it down for us.
So nearly 2/3 of that total revenue, that's about $443.7 million, came strictly from their components segment.
Okay, so that's the raw optical hardware.
Exactly. The other third, which is $221.8 million, came from their systems segment. That side handles the broader integration solutions. So both sides of the business are growing at over 60% year over year.
Wow. But it's those hardware components that really interest me. What exactly are they selling that is in such crazy high demand?
The crown jewels of their component segment are their high-speed transceivers.
Transceivers. Okay, explain that for the listener.
To put it really simply, a transceiver is basically a translator. It sits right at the edge of the server, takes the electrical signals, the ones and zeros generated by the NVIDIA GPU, and translates them into microscopic pulses of laser light.
Okay.
Then it shoots those light pulses through fiber optic cables all the way across the data center to another server, where a different transceiver catches the light and translates it back into electrical data.
Okay, so Lumentum is literally manufacturing the lasers and the translating devices that make that light speed communication possible.
That's exactly right.
Okay, the technology makes sense. But, my skepticism always kicks in when I see rapid growth in hardware.
Of course.
Historically, it is very easy for a tech company to just buy revenue growth by slashing their prices, which, completely destroys their profit margins. Empty growth is a massive danger in this sector. So how are they actually handling profitability?
Your skepticism is entirely warranted here, but their margin profile is actually incredibly resilient. They just posted a non-GAAP gross margin of 42.5%.
42.5% in hardware.
Yes. And to give you some context on why that matters, pushing gross margins past 40% in physical hardware manufacturing is incredibly difficult.
It's almost unheard of unless you have serious leverage.
Exactly. It tells you they have serious pricing power. They're not just selling some cheap, interchangeable commodity part. They're selling a highly engineered product that their customers desperately need right now, and they can't easily source it from a cheaper competitor.
Right. But does that pricing power actually make it down to the bottom line? Or are they spending it all on R&D and marketing?
It definitely makes it to the bottom line. Their operating margin expanded nicely to 25.2%.
That's solid.
It really is.
Yeah.
So when you combine a 65% surge in sales with that kind of operating margin, you get a very healthy bottom line. They delivered $143.9 million in net income.
Which translates to what, like an EPS of $1.67?
Exactly. $1.67, which comfortably beat Wall Street estimates by 0.25 cents.
Okay, those are undeniably strong historical numbers. But, the stock market is a forward-looking weighing machine. Investors are not paying a premium for what Lumentum did yesterday. They're paying for what they believe the company is going to do tomorrow.
And that forward-looking projection is exactly what caught the analyst community so off guard recently.
How aggressive are we talking?
Yeah, very aggressive. For their third quarter, the guidance they provided has a midpoint of $805 million.
$805 million for a single quarter.
Yes. But the longer-term projections are what forced analysts to just completely rip up and rewrite their financial models. Wall Street is now modeling their fiscal 2026 earnings per share to hit $7.63.
Wait, $7.63? That's a massive jump.
It's a 270% jump compared to previous estimates.
270%.
Yeah. And looking out even further to fiscal 2027, total revenue is projected to reach a massive $4.7 billion.
Okay, a 270% upward revision essentially means the experts had to admit their previous models were completely broken. They clearly underestimated the sheer speed and the scale of this data center build-out.
They absolutely did.
But here's what I don't quite get. There are other companies in the optical space, right? Like Coherent. Why is Lumentum capturing such a disproportionate share of this new value? What's stopping a rival from just stepping in and undercutting their prices?
It all comes down to their competitive moat.
Yeah.
And it's significantly deeper than it appears on the surface.
Mm-hmm.
First of all, they have incredibly deep intellectual property in these high-speed transceivers and lasers. They aren't just shipping standard off-the-shelf parts.
They're customizing them.
Highly customizing them. Their advantage relies heavily on customized integrations. They work directly with the hyperscalers, the huge cloud computing providers, building these AI data centers to design optical architectures that fit their specific, unique layouts.
So they're basically tailoring the physical plumbing to the specific building.
Yes. And when you customize the hardware to that extreme degree, you create incredibly high switching costs.
Because you can't just rip it out easily.
Exactly. If a hyperscaler wants to drop Lumentum and switch to Coherent or someone else, they can't just unplug one device and plug in another. They would have to completely re-engineer major portions of their network architecture.
Oh, wow.
It creates a powerful physical lock-in effect. Plus, Lumentum is heavily invested in scaling its manufacturing base right here in the U.S.
Which is huge for supply chain security right now.
It's a top priority. Tech giants want to know their critical components aren't vulnerable to international trade disputes, that U.S. manufacturing base acts as a huge barrier against foreign rivals. And clearly, the strategy is working. Their AI-specific product lines are surging 90% year over year.
Okay, moving over to the technicals and price action. Because if the underlying business is that solid and the future projections are that high, why is the stock chart making people nauseous?
It's been dramatic, to say the least.
Let's trace this recent price action for you, the listener, because it's been an intense roller coaster. On March 2nd, the entire optical sector experienced this massive, euphoric surge.
Huge volume that day.
Massive. But the very next day, March 3rd, the market delivered a brutal reality check. We saw an 11% sell-off on incredibly high trading volume.
Which Definitely caught a lot of people off guard.
To put that volatility into perspective, the stock touched a dizzying high of $694.43 right before that sudden pullback. And now it's aggressively testing this psychological zone between $600 and $700.
Right.
As an observer, it feels like classic human psychology at play. When a stock climbs that quickly, people see these massive unrealized gains in their accounts, and the instinct to just hit the sell button and lock in profits becomes overwhelming.
That psychological aspect is totally key to understanding the chart right now. Look, an 11% drop in a single day sounds terrifying in isolation.
Yeah, the headlines make it sound like the sky's falling.
Exactly. But you have to contextualize that drop within the broader momentum of the stock. A pullback of that magnitude, directly following a historic sector-wide run-up, is a textbook example of market digestion. It's expected profit-taking. It is not necessarily an indication that the underlying bullish momentum is breaking down.
So you don't view that high-volume sell-off as a structural red flag?
I don't. Because if you step back and look at the underlying trend, the stock is still maintaining what technicians call a higher high structure.
Explain that for us.
Think of it like a staircase. Even though it took a step back down from that absolute peak of 694, that new low is still significantly higher than the previous baseline. Remember, right after they announced that massive Q2 earnings beat, the stock popped 9.11%.
Right, that huge jump on earnings day.
That 9.11% pop established a new floor of perceived value. Even with this recent 11% drop, the price hasn't broken below that crucial post-earnings support level.
So for the everyday investor trying to navigate this, what does a chart structure like that actually signal? You're saying this could be a strategic accumulation setup.
Very often, yes. Setups like this act as an accumulation phase. The reactive traders take their quick profits and leave. Meanwhile, the institutional investors use these dips as an opportunity to quietly build larger, long-term positions before the next upward move.
Well, let's gauge the market sentiment and see what the big money is actually doing then. Because while the daily charts show this tug of war between retail buyers and sellers, the underlying corporate moves are sending a very loud signal.
And the loudest signal in the entire tech sector right now is coming directly from NVIDIA. This is the biggest tailwind driving the market mood for Lumentum.
Let's unpack that.
We are looking at a relationship that goes way beyond just a standard vendor contract. NVIDIA has committed to a multi-year $2 billion direct investment in Lumentum.
$2 billion. That is a massive amount of capital, even for NVIDIA.
Exactly. And keep in mind that $2 billion direct investment is coupled with multi-billion-dollar purchase commitments for the actual AI optics hardware. You have to recognize what a profound vote of confidence this is.
They're essentially funding their own supplier.
NVIDIA is dictating the pace of the global AI rollout. By injecting $2 billion directly, they're telling the market that their own future roadmap relies so heavily on optical technology that they are willing to personally bankroll Lumentum's manufacturing expansion, just to ensure the supply chain can keep up with their needs.
It is a phenomenal catalyst, but I want to interject with a reality check here, because despite that massive NVIDIA investment, if you look at the quantitative sentiment scores across major financial platforms right now, they are sitting squarely at neutral.
They are surprisingly flat right now.
Right. And a big reason for that is the recent parabolic rally triggered a lot of cautious advice from traditional analysts. When a stock approaches $700 that rapidly, the establishment voices get nervous.
They definitely do.
I mean, look at Jim Cramer. He specifically warned his listeners right after the rally peaked, and I quote, "I would be a seller."
You can certainly understand the hesitation from the traditional analyst crowd. When a stock moves that fast, standard valuation models just start to break down. It feels overextended to them. However, I would push back on that cautious, neutral sentiment by pointing you toward the immediate horizon. There is a major upcoming event that has the potential to shift the narrative right back toward aggressive buying.
Was the catalyst?
On March 15th, the world's biggest optical networking event is taking place.
Okay, but industry conferences happen every week. Why is this specific event going to move the needle for the stock?
Because this year, the entire focus of the event is shifting. It's going to put a massive global spotlight squarely on AI infrastructure plays. Every major tech company, hardware analyst, and institutional investor is going to be laser-focused on how optical data transmission is solving the data center bottleneck.
Oh, I see. It's a visibility thing.
It provides a highly visible stage for Lumentum. When investors are broadly reminded of the physical hardware required to make software like ChatGPT actually function, It historically sparks a renewed wave of capital rotation into these specific infrastructure stocks.
Okay, time to play devil's advocate and dig into the bear case. Because no matter how brilliant the underlying technology is or how impressive the revenue growth is, you have to critically evaluate the risks to protect your downside.
Absolutely. Risk management is essential.
Let's outline the major hurdles. First, we cannot gloss over the extreme sector volatility we just talked about.
Mm.
An 11% single-day drop means you need a very strong stomach to hold this stock.
It's not for the faint of heart.
It's really not. But second, and I think this is much more important, there is a critical structural risk here. NVIDIA concentration exposure.
The single mega customer issue.
Yes, you have to ask yourself, is Lumentum becoming dangerously reliant on a single customer? Yes, the $2 billion investment is a great headline today, but history is littered with component suppliers who rode the coattails of a giant tech company, only to be utterly crushed when that giant decided to change its architecture or bring manufacturing in-house. What happens to Lumentum if NVIDIA suddenly pivots?
It's a highly valid concern. And examining that exposure is exactly the kind of critical thinking you need to be doing. But let me present the risk mitigation argument here. Many institutional investors believe these risks are actually mostly priced in already.
How so?
While the rapid run-up makes it an easy target for pundits like Kramer to call a top, you have to look closely at the mechanics of the NVIDIA partnership. The $2 billion commitment from NVIDIA effectively locks in multi-year demand.
It's contractual.
Exactly. Lumentum isn't just building new factories on the speculative hope that orders will show up. They are expanding to fulfill guaranteed contractual purchase orders. That provides a really thick safety net for their manufacturing expansion.
Okay, but what about NVIDIA swapping them out for a cheaper supplier in 2 years?
Developing high-speed optical transceivers at this specific scale, with the reliability required by a hyperscale data center, is incredibly difficult engineering. NVIDIA can't just easily switch to a cheaper overseas supplier.
Because of the customized integration we talked about?
Precisely. The cheaper supplier simply does not have the US-based manufacturing capacity, nor the custom technology required to handle the bandwidth NVIDIA needs today. The high switching costs actually protect Lumentum from the very concentration risk that NVIDIA represents.
Let's bring this all together for the final verdict. We've unpacked a lot of complex data today. We looked at the fundamental growth driven by this transition from copper to optical fiber. We analyzed the rollercoaster technicals and the psychology behind that 11% pullback. And we weighed the massive NVIDIA catalyst against the structural risks of customer concentration.
We covered a lot of ground.
So taking all of this into account, what is the official rating for the listener as they evaluate their portfolio?
When you run all of this fundamental and technical data through the quantitative models, Lumentum earns a highly convicted bullish score of 9 out of 10.
9 out of 10.
Yes. If I had to give you the final elevator pitch, it's this. Lumentum is the core AI optics engine. They have expanding margins, they have a locked-in multi-billion-dollar NVIDIA partnership, and they have a direct path to $4.7 billion in sales by fiscal 2027.
So what's the official designation?
We designate the stock as a multi-year hold into FY 2027 ramps. This isn't something you day trade. It's an asset you hold to capture the realization of this massive AI infrastructure build-out.
And I want to leave you with one final provocative question to ponder. With that massive March 15th optics event looming, an event that will likely dominate tech headlines, is this recent 11% pullback the last chance to accumulate shares before Lumentum permanently breaks past the $700 barrier? It's definitely something to seriously consider as you review your own investment timelines.
Definitely something to watch closely.
That wraps up our analysis for today. As usual, before we leave, subscribe, like, and comment to this video to support the show. Let us know what company you want us to investigate next. We'll see you in the next one.